Bienvenidos todos y muchas gracias.
Welcome, everybody, and thank you very much for connecting with us today in this third session and last session of our financial challenge cycle called XVA Experience. This is the space where we will analyze in depth what this calculation means and how its calculation involves a better risk management of the counterparts. This webinar can be heard in English and Spanish by selecting the platform language of your comfort. We'd like to remind everybody that you can access this complete recording in VMetrix.com and at our official social media. I'd like to invite everybody to send your questions through the chat for our main guest and for our expert panel in VMetrix. Also, I'd like to tell you that at the end of the webinar, we'll have a raffle of the latest book, Machine Learning in Business, an Introduction to the World of Data Science, by our expert and main speaker today, Dr. John C. Hall. So this will be raffled for those of you that are connected during the whole transmission. Now I will leave you with Monica Sanchez, Chief Revenue Officer of VMetrix. Welcome to the closing of our Financial Challenge 2022. As VMetrix, we'd like to thank you for your participation in this first cycle of webinars. In this space, we've tackled what we believe are the main topics that are key for the industry. And we have held a conversation with who we believe are points of reference in investment and finances, and we're very happy to have an author and academic of the world level like Dr. John Hall for this analysis and discussion. We'd like to open this cycle by analyzing the regulatory changes that the financial market is going through to the end of the year. In the second masterclass, we got into depth of machine learning and how this has become a fundamental piece for credit derivatives and coverage, as well as a full portfolio management. For the final management session, we'll have a full XVA experience where the main speaker will talk about the process in the creation of XVA as the new adjustment for derivatives and why it's key to incorporate it in the administration processes. Now, I'd like to leave you with Pedro Melo, CEO of VMetrix for LATAM. Thank you, Monica. And I'd like to thank everybody that's here with us. In VMetrix, we've been working for many years in the development of innovative technologies, where our SaaS solutions will be the first and only platform and services modality to make the full administration of finances streamlined. And here we have an efficient derivative management because we want to include all types of financial institutions to access metrics that can improve their decision-making process, especially for the administration of their assets. We seek to change the paradigm of how the cycle of investment is managed with a world-class management system in services modality that includes 90% of the instruments with pre-configured, preloaded data to be used in Chile, Mexico, and Paraguay. We want to facilitate family office, brokers, pension funds, bank institutions to the digitalization of their front-to-back processes without long periods of implementation and costly investment in infrastructure. We'd like to deliver a solution that's ready to use. Now, in the name of the whole VMetrix team, I'd like to welcome you to the latest edition of Financial Challenge 2022. We're here with us with Mr. Victor Rebolledo, Head of Data Engineering, and Mr. Luis Ginero, Functional Risk Management Leader of our company. So in an economic scenario that's as complex as the one we're living through today, a risk policy is key to assure the management of derivatives within the investment portfolio. What impact will be held in the new XVA calculation in this context? This and many other questions will be part of the conversation that we'll hold with Dr. Hall and our panel of experts in just a few moments. Now then, we'd like to give the opening remark to Dr. John C. Hall, Maple Financial Group, and Joseph L. Rodman Faculty of University of Toronto. Dr. Hall is also co-director of the Master's Programs in Finances and Financial Risk Management of Rotman School of Management. Dr. Hall, welcome, and thank you very much for being here with us in this third edition of Financial Challenge VMetrix. The floor is yours.
It's my pleasure to be here, and I'm looking forward to presenting this video that we've prepared on XVA. I mean, XVA is something that's become really important since the crisis, since the global financial crisis. And I think it's something which my students really need to know about, and I think everybody throughout the world needs to know about today. Well, hello and welcome. My name's John Hull, and this is the third of my seminars with VMetrix. This one's called the XVA experience. XVA, as you may know, is the word used to describe all the different VAs, the valuation adjustments that we make in derivatives. So it used to be the case that all you needed for derivative pricing was something like the Black-Scholes model for European options. If you've got an American option, then you'd have to use a binomial tree or finite difference methods. And if you had a more complicated product, maybe a path-dependent product or something like that, you would use Monte Carlo simulation. So you just use one of those tools to value the derivative. But since 2008, more attention has been paid to these valuation adjustments, as they call the VAs. And there are just so many of these VAs that they're collectively referred to as XVAs, where we can have a number of different X's. So let's start with the most important one, CVA, credit valuation adjustment. And so it's an adjustment which, of course, we've always worried a little bit about. It's an adjustment to the no default value of a bilaterally cleared derivative arriving from the possibility of a counterparty default. Typically, it has to be calculated on a counterparty by counterparty basis. You don't have to look at individual transactions because there are netting clauses in the master agreement that says that if the counterparty defaults on one contract, they default on all contracts that they have with you. So the contracts are all netted out in the case of a default. So how do we calculate CVA? Okay, there's two things we need to know, or we need to think about. One is the probability that the counterparty will default at different times, and the other is the expected exposure when the counterparty defaults. So what we've got here is Q1, which is actually refers to the time period between 0 and T1. So I should say, first of all, you divide the time. You look and see what is the longest contract that I have with a counterparty. So we're thinking about one particular counterparty here, and you look for the longest contract you have with that counterparty, and that will be the capital T here. And then you divide the time between now and capital T into a number of periods. 0 to T1, T1 to T2, T2 to T3, and so on. Q1 is the probability that the counterparty will default in the first interval, 0 to T1. Q2 is the probability the counterparty will default in the second interval, T1 to T2. Q3, the third interval, and so on. And then the question is, what's your exposure if the counterparty defaults? And that's the V's. So if the counterparty defaults between 0 and T1, you assume the counterparty defaults the midpoint of that interval, and V1 is what you expect your exposure to be, or what the average exposure will be if the counterparty defaults at the midpoint of that first interval. V2 is what you expect the average exposure to be if the counterparty defaults at the midpoint of the second interval, and so on. So I'm going to talk about this in a minute, but you have to estimate those probabilities of default, which I've called Q1, Q2, and so on, and your expected exposures at the midpoints of the intervals. And CVA is given by this formula at the bottom here. So you multiply Q1 by V1, add it to Q2 multiplied by V2, and Q3 multiplied by V3, and so on. So you're multiplying the probabilities of default by the exposures, adding them all up for all the different intervals, and then you'll have to also estimate what your recovery rate will be in the event of a default. So you multiply by 1 minus the recovery rate, okay? Because hopefully you won't lose everything. There will be some recovery. So CVA, as I say, is 1 minus the recovery rate times the sum of what you get when you multiply the Q's by the V's. So how do we estimate the Q's, first of all? These are the probabilities of default. Well, there's two alternatives for doing this. One is to sort of use historical data and say, well, what's the probability of a counterparty defaulting if they're similar to this counterparty we're looking at? And the other is to imply it from credit spreads. So you might think those would give similar answers, but they don't. The historical data for companies with similar credit rating, the historical data on defaults, gives a probability of default which is quite a lot less than the probability of default you imply from credit spreads. And that's the difference between estimating something in the real world and estimating it in the risk-neutral world. So the question is, should we use a real-world estimate for the probability of default, which would be using historical data, or should we imply it from credit spreads, which would be the risk-neutral? And actually, these give quite different answers. And it's correct. It's actually correct to imply probabilities of default from credit spreads in a valuation exercise. When you, as we know from how we value derivatives and other things, what we're interested in doing usually is estimating whatever variables are concerning us in a risk-neutral world and then defaulting at the risk-free rate. And that's what we do here. So we want risk-neutral estimates. And I should have made the point here that what we want to do is estimate not the exposure at the midpoint, but the present value of the exposure at the midpoint, the present value being calculated using the risk-free rate. So we have to go from credit spreads to default probabilities. Suppose ST is the credit spread. How do we go from that to a default probability? So we're looking at one particular maturity now. And it turns out that we want to use what are called hazard rates. And the hazard rate is the probability of default conditional on the fact that there's been no earlier default. Okay, so it's not the probability of default as seen at time 0, but it's the probability of default at a certain time conditional on no earlier default. So it turns out that the average hazard rate between time 0 and time t is the credit spread divided by 1 minus the recovery rate. And I think you can see that because the credit spread is just the average hazard rate times 1 minus the recovery rate. So, so if we want to have the probability of default between time 0 and time t, we get this expression, final expression on the slide, which, as I say, the hazard rate is the probability of default conditional on no earlier default. So we've got to do some integration to get the total probability of default between time 0 and time t. And that's what this expression gives us. So what we want, of course, to do this, we want the probability of default during this first interval, during the second interval, during the third interval. So what we do is we use our estimates of the credit spread to calculate the total probability of default between time 0 and time t1, total probability of default between time 0 and t2, total probability of default between time 0 and t3. And then by subtracting those, we can get the probability of default in each interval. Now, what about expected exposures? Well, they're more time-consuming to calculate. What we've got to do to get the expected exposures, and remember, these are the exposures at the midpoints of those intervals. We basically simulate a lot of paths which the derivatives that we're talking about can follow. So what we're actually simulating are the paths for the assets that underlie the derivatives with the counterparty, and we simulate lots of paths for those. And on each path, we calculate, well, if the variables underlying the derivative follow these paths, this will be our exposure in the first interval, this will be our exposure in the midpoint of the second interval, and so on. And then we do it again and again and again, and then we average all the exposures to get the expected exposure. Okay, so it's just a big Monte Carlo simulation exercise for all the variables that underlie the derivative. We have got to take collateral into account, and there's a little bit of a problem here in that you might think, well, if we're assuming the counterparty defaults to the midpoint of an interval, we should worry about what the collateral the counterparty would be posting at the midpoint of an interval. But in fact, if the counterparty gets into financial difficulties and defaults, the chances are the counterparty stopped posting collateral quite a few days before that. So, and 10 days would be a typical assumption. So we would assume that the counterparty stopped posting collateral 10 days before the time when the counterparty defaults. And we would have to calculate the collateral that we would actually have at the time of the default by looking 10 days earlier to see what the exposure is then. Of course, if we've posted collateral with the counterparty, that's kind of like a negative collateral, and it will increase our exposure. Now, it's kind of interesting that this CVA risk is increasingly regarded as a derivative. It's a derivative. As market variables change, our CVA changes because our exposure can go up or down. And of course, the probability of default of the counterparty can go up and down. And so dealers are being encouraged to manage this like any other derivative and try and hedge the risk in a CVA exposure. So, and regulators, in fact, in Basel III, regulators require banks to keep capital for the risk related to the probabilities of default. And then in Basel IV, they want banks to keep separate capital for CVA risk relating to both the probability of default and the exposure, the expected exposure at the time of default, so to both the QIs and the VIs. One concept in CVA is what's known as wrong-way risk or right-way risk. And if you think about that formula we had for CVA, we multiplied the QI by the VI, and we estimated each one separately. So we estimated the probability of default quite separately from the exposure at default. Implicitly, we assumed that the probability of default was independent, uncorrelated with the net exposure. Now, wrong-way risk would occur when actually, if you have a big exposure to the counterparty is more likely to default. So QI, the probability of default, is positively related to VI. And then right-way risk would be the opposite, when QI is negatively dependent on VI, which would be a nice situation when you have a big exposure to the counterparty. For some reason, they're less likely to default. Of course, most of the time, we're in the wrong-way risk category. Here are some examples. If the counterparty is selling credit protection, or is a hedge fund taking a big speculative position, that would be a wrong way risk situation. Whereas when the counterparty is hedging, we'd be in a right way risk situation. So, you know, it depends. Most of the time, as I say, we're talking about wrong way risk, but occasionally you can argue that it's the situation we're in with the counter situation. So one can come up with complex models for estimating wrong way risk. What regulators tend to do is to say, assume no dependence between the Q's and the V's. In other words, assume zero wrong way or right way risk. Assume the Q's and the V's are independent. Do your calculations and then apply an alpha, what's called an alpha parameter, which the regulators have put at 1.4. In other words, what say is do all your calculations assuming no dependence and then add 40%. Now, if you have your own model for, you know, estimating the impact of wrong way risk, then you can use it, but there's going to be an alpha limit of 1.2. In other words, whatever your own model says, it can't give you a CVA which is below 20% above the independence assumption. So you've got to do the calculations assuming independence, add 20%, and that's a kind of flaw to the calculations. Okay, so we said a bit about CVA. Let's just say a few things about DVA now. DVA is another VA, another valuation adjustment. It's called debit or sometimes debt valuation adjustment. And it's a bit more difficult to get your mind around this one, but if you think about it, let's suppose you're entering into all these derivatives with the counterparty. You've got a CVA because the counterparty might default, but the counterparty has a CVA because you might default. And your DVA is the counterparty's CVA. The DVA is the adjustment default. And again, it's going to be calculated on a counterparty by counterparty basis. It can be calculated actually at the same time as CVA. The same formulas apply, except VI is the counterparty's exposure to you, the bank, and QI is the bank's probability of default. So you look at your own probability of default and the counterparty's exposure to you. Now, the interesting thing is that DVA actually increases the value of the derivatives to you. So when you adjust for both CVA and DVA, you subtract CVA from the no default value, but you add DVA. Okay, you add. Now this is, you know, something that people have a lot of difficulty getting their mind around. And one illustration that I often use is in the third quarter of 2011, all the major banks in the US had their credit spread increasing just because of the general economy and so on. So Wells Fargo credit spreads went up by 63 basis points, JP Morgan 81 basis points, and so on. What does that mean? That means that when you do the calculations indicate, okay, because, you know, those higher credit spreads are going to give higher Qs for the banks. They might default. And what that actually means, of course, is that DVA goes up. And if DVA goes up, their profit will go up. So we have this sort of counterintuitive result that because their credit spreads have gone up and they're more likely to default, the value of their outstanding derivatives is greater. One way to think about this is if I'm a bank and I'm more likely to default, there are some circumstances when I'm not going to pay what I owe on these derivatives. I'm going to default, and my counterpart is not going to get what they're due, and that will benefit somebody. It may benefit the people who, when I get wound up, assuming I'm defaulting, it'll benefit my creditors. So, one thing I didn't mention about CVA is that when a new trade comes along, and you have to think about CVA, what you're interested in is, will that new trade, will it increase my CVA or reduce my CVA? So what you're interested in is the incremental effect of a new trade on your existing CVA with that counterparty, and similarly DVA as well. But let's focus on CVA. So if a trader is on the phone to a client and client wants to do a deal which is kind of in the opposite direction to all the other deals the counterparty has with the client, then it could well be that CVA will go down, because exposures will go down, because the new deal is kind of direction to the existing deal. So how does the trader know that this is, that a particular deal that comes across the desk has a positive CVA or positive incremental CVA or a negative incremental CVA? And the answer is that they do something quite clever to help the trader quickly determine this. When they're doing all these Monte Carlo simulations to calculate CVA, suppose they might do the simulations every night, or maybe even just once a week. But whenever they do them, they remember all the paths that the underlying variables followed to calculate the V's. They remember the paths, and then this new deal comes along. All they've got to do is to simulate the new deal for the same paths in order to see what the effect on CVA is, and if they want to, on DVA as well. So in other words, by doing a Monte Carlo simulation to calculate the V's, by remembering the paths that were used to calculate the average V's, they can calculate the incremental effect on the V's of this new deal. And of course, if the counterpart, if you haven't got any existing deals with the counterparty, then that's irrelevant. But there'll be a tendency that the end user will get the best pricing from a bank with which it has a large existing portfolio, because there's more opportunities there for CVA, for the incremental effect of CVA to be less than what the CVA would be on a standalone basis. Okay, so we've talked so far about CVA, credit valuation adjustment, and DVA, debit valuation adjustment. Let's now talk about FVA, which is funding value adjustment. And this is concerned with the situation that's illustrated here. We have a bank A, so we're bank A, and we enter into this deal with a corporate client, which we're receiving floating and we're paying 2.9%. And then we hedge that deal by entering into an offsetting deal with another bank, where we're paying floating and receiving 3%. So we've got these two swaps which cancel each other out, except we're receiving 3% and paying 2.9%. So we should be making 0.1% on these transactions. But what about the collateral that we've got to post? It could well be that the deal with the corporate client involves no collateral. The corporate client we're doing business with all the time, and there's no collateral posted by either us or the corporate client. But our deal with Bank B, which will go through a CCP, I mean, that will almost certainly involve posting collateral. So we're in the situation where, although it looks as though we've made 0.1%, we've got to worry a little bit about the fact that collateral is going to be posted on one side of the deal and not on the other side. And that's where funding valuation adjustment comes in. So as this says, the swap with the bank will be cleared through a central clearing party, and the bank will post initial margin plus variation margin. The swap with the client might well require no margin at all. So if the swap with the bank is out of the money, so if Bank A has entered into this swap with Bank B, it's receiving 3%, if that swap is out of the money, then Bank A will have to, let's go back to this chart here. Bank A will then, if this is Bank A's swap here is out of the money, then Bank A will have to post variation margin with Bank B. And it's not receiving any variation margin from the corporate client. So that's a funding cost. Okay. On the other hand, it might be the case that it's in the money on the swap with Bank B and out of the money with the swap with the corporate client. The fact that it's in the money with Bank B would mean it would be receiving variation margin from Bank B. And so the funding valuation adjustment would work in Bank A's favor in that situation. So there's an asymmetry here in that we've got variation margin posted on one side of this transaction, but not on the other side. And it's just a question of whether Bank A is receiving variation margin or paying variation margin as to whether the funding valuation adjustment is positive or negative. And that's the point that's being made here. So this is making the point that it could be negative as well as positive. And it can be calculated, this particular one can be calculated on a transaction by transaction basis if you want to. Okay, so FVA, funding valuation adjustment, relates to variation margin, and it can be positive or negative. So what's the cost of it? Well, typically, you estimate what the average FVA is, and you apply a cost of funds to it. We'll come on to that in a moment. Okay, let's just move on to another one now. MVA, margin valuation adjustment or margin value adjustment. And this is, whereas FVA related to the variation margin, MVA and so the bank has to post initial margin. Now, probably, generally speaking, you will receive some sort of interest rate on the initial margin, as you might on the variation margin, incidentally, but the interest rate that you will receive or pay, depending on which way it goes, is generally less than your funding cost, and that's where the cost comes in. Okay, so we've talked about two additional VAs here, FVA and MVA. FVA, as I say, relates to the variation margin, and MVA relates to the initial margin. As I say, in most situations, there will be some sort of interest rate paid on those two, but it's probably not enough to satisfy the bank, because the bank will compare the interest that it pays or receives with its average debt funding costs. And it'll, if it's receiving some interest on some funds that it's posted, probably the interest is not as great. Not probably, almost certainly, it's not as great. Now, there's some, if you think about this from a financial economic theory perspective, initial margin and variation margin, there's something you've got to post to do business. It's part of trading derivatives. And they're relatively low-risk investments. In other words, you're not likely to lose money as a result of posting initial margin or variation margin. And so whether you should compare the interest rate you earn or pay on your average debt funding costs is debatable. Maybe the interest rate that applies to these transactions should be quite a lot lower than that. And, you know, it's an example down here. The bank's average debt funding costs is Fed funds rate plus 100 basis points. Because margin is a low-risk investment, the return required on the margin is the Fed funds rate plus 10 basis points. The interest earned on the margin is the Fed funds rate minus 20 basis points. So you could argue in that situation that we should be comparing those last two interest rates, and really the margin you post is costing you 30 basis points because the return you should be getting on the margin is 10 basis points above the Fed funds rate, and you're actually getting 20 basis points below. But the tendency of financial institutions is to compare the interest earned on the margin with the debt funding costs, which in this case is the Fed funds rate plus 100 basis points. So you would say, so the bank would say it's losing 120 basis points, whereas a theoretician would say, no, you're actually only losing 30 basis points because this is a really low risk investment. Okay, KVA, capital valuation adjustment, okay? Yeah, it's not that people don't know how to spell the word capital, it's just that we've already used the C for credit, so we've got to have another sort of letter for capital valuation adjustment, and so we choose K. So KVA is the capital valuation adjustment, and this is an adjustment for the incremental capital requirements associated with a derivative. So basically, you've got to do some quite complicated calculations to find what's the incremental effect of this derivative on the capital that I'm required to keep. Most banks regard capital as a cost, and the cost of the incremental capital is the required return on equity. Again, there's a difference between theory and practice here, because most financial economists would argue that having to hold additional equity is not really a cost, because holding additional equity makes the bank less risky and should reduce the required return on both debt and equity. So as I say, there's a difference between the way banks think about capital. Banks regard equity capital as a cost, whereas financial economists wouldn't do that. So I haven't got into details about how you calculate FVA, MVA, and KVA, except, what we can say is it's very similar to in terms of the way you go about it, it's very similar to the way you calculate CVA and DVA. It involves very time-consuming Monte Carlo simulations. You simulate all the different ways in which the underlying market variables can evolve, and you think, well, okay, if they evolve like this, what's my FVA going to be? What's my MVA going to be? What's my KVA going to be? And then if they evolve some other way, what are those three things going to be? And so on. Okay. Finally, machine learning can help. I think we've talked about this last time in my presentation on machine learning. If some derivatives can be valued very quickly. So you can say that if the underlying market variables evolve in a certain way, we can be, we can calculate the value of this derivative and this derivative and this derivative. But sometimes we have to use Monte Carlo simulation to value the derivative itself. So then with these XVA calculations, we've got what might be termed a Monte Carlo within a Monte Carlo problem, because we're doing a Monte Carlo simulation to calculate say CVA or FVA or whatever it is. And then within each simulation of the underlying market variables, we have to do a Monte Carlo simulation just to value the derivative or one or more derivatives that we've entered into. So as I sort of talked about in my last presentation, one way around this is to do a lot of work up front to create a neural network which imitates the way in which Monte Carlo simulation will price a particular derivative. And then by working forward through that neural network, you can value the derivative very fast. So thank you. That's what I wanted to say. I'd be happy to take any questions.
Le queremos dar las gracias al Dr. Hall por esta presentación y a continuación vamos
Thank you,
a...
Dr. Hall, for the presentation. And now we'll start with the Q&A session. So please remember that you can send them directly in the chat. So for the study, we have our expert panel VMetrix to talk about the main points that the masterclass touched upon. We have Pedro Melo, CEO for VMetrix LATAM, Monica Sanchez, Chief Revenue Officer, Victor Rebolledo, Head of Data Engineering, and Luis Cisteros, Functional Risk Management Leader. Luis is here remotely. He's not here in the studio, but he's here with us from Mexico. So for those of you that have just joined us, we give you the warmest of welcomes, and we hope that you heard our expert in the third and last webinar of a financial challenge cycle. In case you haven't been able to do that, the recording will be available for VMetrix in social networks and in the website vmetrix.com. So let's review the questions that we have now for the panel. Okay, the first one, it's for Dr. Hall. So this first question, Dr. Hall, from the audience is for you. Nicolas has stated the following: what are the benefits of an XVA calculation for non-banking institutions?
That's a very good question, because of course my presentation was largely focused on this from the perspective of banks. I think it's really important, if you're a non-banking institution, to understand how banks view derivatives and how they price derivatives. In other words, you'll get a better deal from a bank if you understand where the bank's coming from as far as the valuation of the deal is concerned and all the adjustments that the bank makes to the deal. So I think increasingly non-financial institutions need to understand as much about all of this as financial institutions do. But it's a good question.
So according to what Dr. Hall mentioned, Luis, what benefits does this deliver in risk management to use an SAS solution and having derivatives in your portfolio? Luis. Hi, Monica. Well, basically, according to what Dr. Hall mentioned, the SAS allows clients something that we're seeking, which is the system of allowing more competition, small scale into the market, and it will give them the capacity of competing in valuation products and sophisticated valuations. Like Dr. Hall mentioned, it's going to allow them to have access to sophisticated valuations, understand it in a better way, and have better pricing, as Dr. Hall said, in the derivatives related to the banks, which is reflected directly in their P&L. So it puts them at a more competitive point with the banks and the pricing. All right, thank you very much, Luis, for this answer. Catalina, who was watching the seminar, she wants to know, what a financial SaaS is. Pedro, can you please answer? Of course. Well, Catalina, a SaaS in simple terms is a service modeling software in the cloud. You can access it through internet with a monthly subscription model or weekly. Now, when we talk about the financial models, the software and the service come in incorporating all the administration processes in managing this. This means that we're going to have the front to back completely as a service imbued in the software, where the main assets, products, curves, metrics, controls, prices, updates, etc., are found in the services subscribed with a client, where it should not include additional costs for all this service included in the system, which generates important benefits for the company: reduction, access from any device, updated and automatic updates without need for maintenance, and quicker support, more efficient support to tackle all the needs that the client has and to tackle the evolution that the market has with respect to the needs and these needs.
Víctor, en el caso de VMetrix, ¿qué ventajas tiene nuestro SaaS?
Victor, in VMetrix, what does this include for SaaS? And how can this impact our potential clients or users? Just like Dr. Hall mentioned, the challenge here is to be able to model a complex derivative, starting from all the derivative positions that we have with a determined counterpart, with positions of netting and collateral, and the various elements. So the derivatives, now these are instruments where the prices derive from subjacent instruments. There's multiple inherent risk factors, and we have all the contractual conditions with the financial sense, with the solid basis to build these metrics, which are complex and that Dr. Hall presented today. How can this impact the users? First of all, we need a truth, a repository where you have all the derivatives and where you can generate these analyses. Now, here we have the conditions which are specific for Latin American conditions, which are our main clients today. Thank you, Victor, for that response. We want to ask Dr. Hall one more thing. Doctor, what's your opinion with respect to the hardware requirements, computer requirements for calculating XVA, and what other sensitivities are involved in derivatives?
Well, this is a little bit outside my area of expertise, but I think I indicated in my presentation that this is a computationally intensive area. It's because I indicated all the Monte Carlo simulations that are necessary, not just for calculating CVA, but also for calculating DVA, MVA. And actually, I might add that, people are thinking up new VAs all the time. There's TVA, tax valuation adjustment, and HVA, hedging valuation adjustments, and so on. So, I wouldn't want to minimize the computational requirements, but, again, this fits in with my previous presentation on machine learning. People are using machine learning to find quick ways of calculating things like CVA and MVA and FVA and so on. It's because after all, it's just you know, if you think about CVA, it's just a complex function of a lot of other variables. So yes, we are talking about some, you know, fairly computationally intensive calculations with associated hardware requirements and so on, but there's a lot of interesting developments going on, which should, you know, should make life a little bit easier.
Claro.
Víctor, ¿cómo
Victor,
afronta los desafíos?
how does VMetrix face these challenges named by Dr. Hall? Well, just like Dr. Hall mentioned, this is a calculation that's very intensive in computer resources. So in one way or another, if we look at it in combinations or combinatory, the institutions have more numerous portfolios than ever. So for coverage and other calculations of their portfolio, in that sense, there's subjacent calculations, for example, for 50 years. This means that in the case of simulating an exposure of derivatives, you have to simulate that long as well. And now the data available in the market is very expansive. So in that sense, you need to know the sensitivity to each one of these data. On the other hand, there's also certain elements which are particular to contractual restrictions in, for example, netting and collateral that influence in this exposure. So if you combine everything, there's many orders of magnitude of revaluation of each one of the derivatives contracts. If also we're interested in calculating the sensitivity over XVA, we can see that that high level of orders of magnitude has to be calculated according to each one of the nodes in that sensitivity. Therefore, if we use a standard methodology, or if we do it in brute force, normally how it's done, with finite differences, this calculation should be done many times over. So in computational terms, we could use a GPU, which is a graphics processing unit, which is adapted to manage this type of problem and simulation. And as Dr. Hall mentioned, after his presentation was over, at the end of his presentation, we could use a machine learning algorithm that could help us replicate the derivatives. There's machine learning derivatives. There's advancements in deep XVA solver, which is a deep neural network, which allows you to replicate the valuation of your portfolio in many orders of magnitude. As VMetrix, we seek to advance to the levels of knowledge without losing out something that Dr. Hall mentioned in the second cycle, which has to do that these algorithms have to be explained to the clients. So we need to be able to explain that to the clients. They need to understand it. If they don't, they can't make decisions upon it. Perfect. Thank you, Victor. Thank you for that answer. Dr. Hall, we have one more question for you. So can you get risk information from news about the counterpart or the positive or negative levels of interaction on websites?
Well, that's a fairly general question. There's obviously one of the things you want to know about the counterparty for CVA, which is the most important VA, of course. One thing you want to know is what's the probability of the counterparty defaulting, and ideally you might have a credit rating for that counterparty and some statistics on how counterparties with that particular credit rating default and what their credit spreads are. Of course, it is the credit spreads and not the historical data on defaults that you're concerned with, as I explained. So the challenge The challenge, of course, is that not every counterparty has got a credit rating, and therefore, you have to then do analyses looking at the similarity of that counterparty to other counterparties for which you do have credit ratings, and therefore credit spreads. So, yeah, I would, I didn't talk about that very much in my presentation, but there's obviously a huge amount of work that's necessary to get, credit spreads, for example, for counterparties. It's and as I say, there's analysis done on, well, what features of the counterparty are most similar or most important in terms of comparing that counterparty to other counterparties for which we do have credit spreads. So, yeah, again, machine learning sort of rears its head a little bit, because when you're talking about similarities and, one counterparty being similar to another counterparty, machine learning has a lot of tools to help you there.
Okay, muchas gracias, doctor.
Thank you very much, Dr. Hall. Also, from the audience, we have Javier that would like to ask Dr. Hall, how frequent is it that bank institutions count DVA or do DVAs?
They do. I mean, I think it's become part and parcel of how you do your accounting now. Interestingly, so accountants, I'm thinking now mostly about North American financial institutions, but I'm sure it's not that much different in Chile. When you're doing your accounting, you subtract CVA and add DVA. It's part of the accounting requirements. But I would make one interesting point on that. Regulators, when they're looking at the value of your equity and deciding whether your equity is sufficient for the risks you're taking, regulators will subtract CVA, but they do not add DVA. So we have this, kind of distinction between what accountants do and what regulators do. Accountants will add DVA, but regulators, when they're calculating equity capital, for risk purposes, will not.
Bueno, estuvimos hablando acerca del DVA. Ignacio también del público le quiere preguntar al señor Hall, ¿los XVA afectan el valor razonable de los derivados? Por lo tanto, ¿el banco y el banco cliente pagarán más o menos impuestos? ¿Todos los XVA se deben contabilizar y afectar estos impuestos?
So is this where we say goodbye?
Vamos a repetirle la
We're
pregunta.
going to ask the question one more time
Oh, sorry.
to Dr. Hull.
Yeah, sorry, I think that question wasn't translated for me.
We're going to repeat the question. Ignacio from the audience is asking about the XVAs. He wants to know if the XVA affects the reasonable value of derivatives. So do the bank and the client pay more or less taxes? Are all XVAs considered, and are they affected do they affect the tax?
Again, that's an interesting question. And in fact, the tax authorities would love to, if tax authorities argue that if you're going to subtract CVA, then you should add DVA. The tax authorities want to, at least, in North America, want to have this symmetry. They don't want to say, well, you pay less taxes because you're subtracting CVA from your reported profits. And that's the end of it. What they want to say is, okay, you can subtract CVA, but you've got to add back DVA. So yeah, CVA will reduce your taxes, but DVA, which, as I said earlier, is an established adjustment for accountants anyway, DVA will increase your taxes. Now, FVA, as we've said, FVA can be positive or negative. So that might increase or decrease your taxes. MVA and KVA will tend to will tend to decrease your taxes, although I'm not sure whether the tax authorities accept those adjustments yet. I haven't looked into that, whether things like MVA and KVA are adjustments that the tax authorities accept. But certainly CVA and DVA are adjustments that the tax authorities acknowledge.
Genial. También, Dr. Holt, tenemos otra pregunta.
Dr. Hull, we have another question from Gaston. He would like to ask if bank credits include the CVA calculation, or does this only apply to financial derivatives?
I've sort of mostly thought about it in connection with financial derivatives. Non-financial derivatives, I mean, there's no reason why the calculations for non-financial derivatives should be any different from the calculations for financial derivatives, as far as I can see. So my answer would be yes, it should apply to non-financial derivatives as well.
Okay, ahí tenemos la respuesta del Dr. Hall. Le queremos
Here we
preguntar,
have Dr. Hull's answer. Now we would like to ask Luis Ignacio. He's asking from the audience, VMetrix, is it capable of calculating XVA stocks as well as the sensitivities of these risks in first and second derivatives?
Pero la parte de los XVAs como lo tenemos
The XVAs, as we have them set up, and how it's been commented before and how Pedro was saying, this is a system that has different developments and implementations that we are making, are being incorporated into the system. And this is what Victor was saying earlier, is that about the sensitivities and how we should manage them. There is a Monte Carlo simulation. And then once you do the CVA and the XVA, you recompute from the curve, you move the different factors and risk factors to the ones that you are calculating the sensitivities to, and then you can recompose the XVA depending on the first and second derivative. In this case, with exchanges, we have the first and second derivative regarding interest rates, which is the most common. But in this case, VMetrix does have a module to process all of these sensitivities and to be able to modify different risk factors and projections, calculate exposures in the future. And so we will be able to look into these incorporations later on. And as Victor is saying, we're constantly searching for this kind of learning and resources and new methodologies and technologies to be able to figure these calculations out. Thank you, Luis, for your response. And today we're going to close this Q&A. And of course, we would like to thank everybody who is here with us today, also online, and to be able to share this knowledge and be with us on one more day. We would also like to say thank you to everybody who's been connected through this entire session, as well as these sessions above. Dr. Hull commented towards the end of his presentation how the machine learning methodologies could help calculate the value adjustments in specific scenarios. So today we would like to give the last book about our last presenter, which has been acknowledged throughout the entire industry. Throughout the next following days, VMetrix will be naming the winner on their social media platforms. In name of everybody on the VMetrix team, we would like to thank you for your participation, especially Dr. Ho. It was an honor to count with your participation today during these conferences.
My pleasure.
And
Tercer e interesante encuentro.
so now we're going to finalize this very interesting meet. We would like to thank our panel of experts and of course, everybody who's participating. We are very, very happy with having been able to finish this cycle of masterclasses with you. Soon, the VMetrix recording will be able to be available on the website in order to be able to relive its best moments or be able to share it through your social media. Thank you very much for being with us today. Until next time.
Mm.